Have you ever felt like the stock market is just too complicated or only meant for financial experts? Don't worry, you're not alone. In today's video, we're going to simplify everything and give you the basics of the stock market in a way that's easy to understand. By the end of this video, you'll have a clear roadmap to start your investing journey with confidence. Let's get started. So, what is the stock market? Think of it as a giant marketplace, but instead of buying fruits or clothes, you're buying shares of companies. When you own a share, you're essentially owning a small piece of that company. If the company does well, the value of your share can go up and you can make money. But if it doesn't, your shares might lose value. Simple, right? Graphic text overlay. Key terms: stock, a share in a company's ownership; shareholder, someone who owns a share; stock exchange, the platform for buying and selling stocks, e.g. NYSE, NASDAQ. Now you might be wondering, why should I invest in the stock market? The main reason is growth. Historically, the stock market has been one of the best ways to grow your money over time. While savings accounts give you minimal interest, investing allows your money to work for you, thanks to something called compounding. Graphic text overlay. Example of compounding: starting with $1,000, growing at 8% annually, becomes $2,159 in 10 years and $4,661 in 20 years. Of course, the market has ups and downs, but over the long term, it tends to grow. That's why patience is key. Let's talk about the key players in the stock market. First, you have the companies. These are businesses like Apple, Amazon, or smaller startups. Then there are investors, which include people like you and me. Next, we have brokers, which are the platforms or apps you use to buy and sell stocks like Robinhood, Fidelity, or E-Trade. Finally, there's the stock exchange itself, which acts as the marketplace where all the transactions happen. Graphic text overlay. Visual hierarchy showing the roles of companies, investors, brokers, and exchanges. So, how do stocks actually work? A company's stock price is influenced by supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price goes down. This is driven by factors like the company's performance, news, and even the overall economy. Example: imagine you own a pizza shop and sell shares to expand. If people believe your pizza shop will succeed, they'll buy more shares, driving up the price. Now let's talk about the different ways you can invest. The most common are individual stocks, owning shares of a specific company; ETFs, exchange-traded funds, a collection of stocks bundled together, making it easier to diversify; mutual funds, similar to ETFs but actively managed by professionals; index funds, funds that track the performance of a market index like the S&P 500. Text overlay. Stocks equals high risk, high reward. If you're just starting out, ETFs and index funds are great options because they're diversified and lower risk than picking individual stocks. And that's it. You now have a solid foundation to start your investing journey. Remember, the stock market isn't about getting rich quick. It's about growing your wealth over time.